equity or if you've invested in any kind of small businesses, what business would you invest in if the entrepreneur came to you and said, here's this great idea, I'm really passionate about it, we're going to really change markets and consumers and the whole nine yards, and here's the deal, here's the term sheet. For every dollar you give me, I'm going to take 95 cents and I'm going to put it on the shelf. And I'm going to take a nickel out of every dollar. I'm going to take my administrative costs out of that, so I get like 2 or 3% admin overhead. So I'm going to take 2 and 3 cents, and I'm going to use that to execute the business strategy. But that's what we do in philanthropy. And we think of that as kind of good philanthropic practice. And the problem, of course, is that it raises a really uncomfortable question, which is, what percent of your assets are actually driving to advancing your institutional mission? And I would argue that if it's 2 or 3%, that's probably not enough. Now, I would not argue that it's got to be 100% all the time. I don't have an answer, because I think, as is true of all investing, different investors have different priorities and goals and intents, and everybody has to kind of find their own appropriate allocation. But the fact is, 2 or 3% is not enough, as far as in my mind. And I think that the new golden rule is basically one that says something along the lines that portfolio size doesn't define the breadth of your vision or the tools that you can apply in creating the future you desire. And that's the key thing, is that it's about much more than grants and social impact. It's about maximizing total performance and value. And so when we think about an investment strategy that drives multiple returns, what we're talking about is a strategy that looks at the whole, that basically is more of a unified investment piece. And you'll give me just a second here. I got to take off this coat. So I'm roasting as I'm starting to talk. And so there's a couple of parts to this. Actually, probably more than a couple, but in any event, we'll start with a couple. And what I'm saying here is that as we think about a portfolio allocation, what we usually do is we think about this part here, and we think about that in terms of financial performance and return. And then we think about payout here in terms of grants that are pursuing social value. And what I would argue is that when we're making our grants, we need to understand that there is a social risk and return equation that's in play. And we need to structure our grants on terms that really are, in fact, a philanthropic portfolio. And oftentimes what we do when we think about grant making is we just kind of have charitable gifts. And they're gifts. You cut a check, it's kind of drive-by philanthropy. You write a check and you get a report a year later and you hope something good happened. And if you're strategic or tactical, you get more engaged. But I mean, basically, it's a transactive piece. It's not an investment approach. Whereas if we take an investment approach to philanthropy, you can see something that says that a program grant is really like kind of low risk. If you think about making a program grant to a homeless organization that's feeding folks, we pretty much know how much it's going to cost to feed 100 people. So here's $1,000 and here's X number of people who get fed. You pretty much know that equation. So it's a pretty easy transaction to make. But if you're wanting to invest in a collaboration of 5 nonprofits that are creating affordable housing within a given neighborhood, and you need to build the organizational infrastructure to be able to execute that strategy over, let's say, a 5 to 10 year time horizon, that's a much higher risk exposure. And so the combination of these two are important, because it's not like you don't do one, but you do the other. You're doing both and, thank you. But if you really want to, quote, solve the problem, maybe you decide what you need to do is move into public policy work. And so you start looking at doing more R&D, doing seed funding of innovative programs and strategies. And again, it's this combination of philanthropic investments in a portfolio management style that creates the impact and the value of doing philanthropy. But the trick here is, again, this represents really that 3 to 5% that we were talking about earlier. Whereas, and I'd also say, this represents money out the door. Okay? This is not revolving funds coming back to you. Whereas if you're doing, again, let's say housing, and you could structure a recoverable grant or a program-related investment that says that, all right, we're going to buy down the interest with our social license, if you will, and we're going to take on greater risk than a commercial banking institution might be able to do given the profile of its capital that it has to work with. And we're going to combine that with the grant piece. Then you've got a situation where you can actually leverage funds. And not only are you leveraging funds in terms of the dollar value, if you put 5 in, you can leverage $100 later kind of thing, but you're also leveraging your own investments in order to begin to incrementally increase the amount of return and performance that you get for the assets under management. And then you begin moving over here to this side, in the public equity side, and let's say the treasury note side, where you have a set of instruments that you actually can buy into that really mirror in some way mainstream traditional investment products, one of which is the community investment note, which Calvert and RSF Finance in the US have done a lot of work around, and which the Ottawa Community Loan Fund is going to be rolling out in the next, I think, 3 to 6 months as an offering here in Canada. But basically is a note that says you can select an interest return, 0 to 3, maybe 0 to 4%, and it's in essence you're buying a fixed note bond is essentially what it looks like. And instead of buying that instrument from the government, you buy it from a community finance institution, and they use that capital then to finance small business development and housing in that community and in that region. And one of my biggest pet peeves about the nonprofit sector is that if all we did was manage our cash flow better, right? If all we did was manage our cash and cash equivalents, we could quadruple, if not create by 100 times, the impact and leverage of the assets we have. But for some reason that I'm not quite clear on, we're more comfortable buying CDs from Bank of America than we are from a community development bank, even if both CDs have the same profile and both of them are secured, in our case in the States, by FDIC, right? So your risk exposure is identical. And yet for some reason, we like paying more money for the Wall Street folks than we do for the Main Street folks. And I don't understand that, but that's just a pet peeve. So I'll just put that out there and move on. But in any event, and so the idea is that increasingly there are a whole host of vehicles and strategies and funds that investors are able to move their investments into in order to be maximizing the greatest value.
In this this rapidly growing field of social finance, and whatever we want to call it, and I'm with you on the